So hey, there's Mike Hamilton, one of the founders of Live Swell Beach Bungalows and also author of Vacation Rental Confidential. And in this book, we go over a lot of different things about the vacation rental business. One of the main things that we go over later in the book is financial principles, real estate investing principles, and I'm going to go over one of those principles today. We're going to talk about shorting the US dollar with rental real estate, with vacation rentals. This is an advanced financial strategy that the wealthy know. The wealthy understand that by using leverage, by using debt, we can acquire a lot of real estate, income producing real estate, and we can build wealth. So you might be asking yourself right now, I'm confused about shorting. What does shorting mean? You hear about shorting in the stock market. You hear about shorting currencies, bonds. Pretty much any asset can be shorted. So what is shorting? Really, really quick. Shorting is when an investor or a trader believes that an asset's going to go down in value, and so they're going to bet that the asset's going to go down in value, and that's how they're going to profit. Now, in the post that accompanies this video, there is a graphic. Now, I didn't create this graphic. It's created by a website called The Balance, and it goes over a short selling example of a stock. Read it over a few times, bang it into your head. It's a very, very high level concept, and if you can grasp it and understand it and implement it, you can absolutely build wealth in many asset classes. But right now, we're going to go over how to short the dollar with vacation rentals. So you'll see another infographic there. This one I did create, and it's a 5-step process on how to short the dollar with vacation rentals. We're going to go over that right here. You can use this document as a guide, this infographic, but we're going to get right into it. So in order to short the dollar, as I kind of mentioned when we were starting this, we've got to be open to debt. So our first step is going to be we're going to identify a lender with favorable lending terms. So hopefully they have long amortization periods, a 30-year loan, and they also have good interest rates. If you're watching this video, it's post-COVID. Interest rates are at an all-time low. It's some of the best debt, some of the best loan opportunity that a home buyer and investor could ever get. So step number one is we are going to identify that lender and start a conversation with them so that we can be prepared to borrow when we have opportunities. So the next step to short the dollar with vacation rentals is going to be to borrow. So we're going to borrow a depreciating asset. Now, I'm going to put this in context right here. We need a little bit of context here. So what is a devaluing asset? Well, if you were to ask a grandparent how much a candy bar cost in the 1920s, 100 years ago, they might say, I remember when a candy bar cost a nickel. Well, how could a candy bar cost a nickel 100 years ago, but it costs about $1.50 or $1 today? Well, the dollar has went down in value, and I'll show you another graphic to help with this concept. And this is also in the post that accompanies this video right here. And what you can see here is that line that's going up, that red line that's going up, that's the amount of dollars in circulation. That's going up like a hockey stick. And you can see the dollar that's kind of ripped there. It's not really ripped. It's just showing it symbolically that it's going down in value. So to short something, we want to borrow something that is going to go down in value. We're going to take out a mortgage. We're going to take out a loan because dollars, we know over time are going to go down in value. That's why we keep seeing over years and years and years housing prices go up. That's why we see inflation, the value of a candy bar, the value of any product really over time is going to it's going to go up in value because of inflation, but the dollar essentially is going down in value in that scenario. So after we borrow them, step number 3, we're going to trade them, right? We want to trade those devaluing dollars, that mortgage, for an appreciating asset. Well, in the United States, in most areas, real estate is an appreciating asset. Now, does it appreciate all the time? Of course, there's a crash here and there. But if we're getting into this, we're going to buy over the long term, and we're trading those devaluing dollars for a house, for a vacation rental, for a rental property that is an income producing asset, right? So that is step number 3. We're immediately going to trade the devaluing asset, the mortgage, for an appreciating asset, a house. So we're trading cash devaluing for a house appreciating, right? And so now in step number 4, we're actually going to be shorting the dollar. And this is really the principle that's important to understand, is the time value of money. I started to talk about it a little bit here when we looked at that infographic of the dollar going down in value, but essentially a dollar today is worth more than a dollar tomorrow. So this is really where hopefully you're going to see how shorting the dollar actually works. So if we're taking out a 30-year loan, right? We're taking out a 30-year loan, right? 30 times 12 is 360. So over those 30 years, you're going to have 360 payments, right? Well, the payment on month number 1, right? So let's do it over here. Month 1, let's say it's $2,000, okay? And that's on month 1. So you can do month 2, 3, 4, so on, right? Every month your financing is staying the same. I'm not saying your taxes or your insurance. Your taxes and insurance can change, but your financing is fixed, right? So that's where we're getting the lender with the favorable fixed rate terms. Now in month 4, the payment's $2,000. In month 120, the payment is $2,000. Month 120 is significant. That is 10 years from now. $2,000 today is going to buy a lot more. It's going to have a lot more purchasing power than $2,000 10 years from now. $2,000 today is going to have a lot more purchasing power than month 240, right? 20 years from now, payment being $2,000. Year 30, right? That $2,000 is not going to buy as much in year 30 as it is going to buy today. So essentially by repaying this loan over time, right, we're paying back dollars that we locked in a long time ago with today's dollars, right? So if you're in the rental business, whether it's a long-term rental, a short-term rental, you're going to be raising your rates over time. You're going to be adjusting for inflation. Unfortunately, the bank is stuck with that note. Don't feel bad for them. They have a lot of benefits. They can make a lot of money. But by repaying this loan over time, we are essentially shorting the dollar. And so in those 4 steps, you've shorted the dollar. And in number 5, you can see some balloons there. Fire off a few balloons because you can celebrate because you've shorted the dollar. Now, the reality is with just one rental, one vacation rental, one traditional rental property, you're not going to necessarily build a lot of wealth. So the point here in number 5 is not only to celebrate, but repeat this process. Repeat this process over and over and over so you can build wealth. Now, that is shorting the US dollar through real estate investing, vacation rentals. Hope you enjoyed that. You can learn more from myself, my business partner Maria at Vacation Rental Dojo. The link is below. We have a lot of great content, tips, resources, tools to help you in your vacation rental investing journey. Thank you very much.